Welcome to Trade the Trend, a weekly video about where the stock market is going. This video is going to focus on the SP 500. I'm going to cover the ASX 200 as well as gold, copper, uranium and oil in a separate video. I'll leave a link for that in the description section below. I'm also going to tell you about my biggest concern for the US indices as they currently stand, so make sure you stick around for that. As always, it's a general commentary, doesn't take your personal situation into account. With all of that said, let's get over to our first chart. So I'm going to start with the SP 500, and it really has been an extraordinary few weeks. We've seen the SP 500 really, it's moved into this big 6% range. First, we had the sell-off, and now we have the hard rally back. And last week was actually relatively calm, considering all the movement we've had over the space of the last 4 weeks. And first thing I want to do, though, before getting into the analysis, I'm going to clean this chart up a little bit. I'm actually going to take this trend channel, which I've been using for the last probably couple of months now. I'm going to remove that because I don't think it adds a lot of value anymore. It just, the way it works is sometimes these chart structures, they can really stack up and work well. Other times they just don't play out. And I think that trend channel really, I don't think it's adding a lot of value. So it's best to remove stuff and avoid clutter on your chart than have stuff you don't need. So now, the way this is currently looking to me is that the immediate vulnerability has now passed. So the key point of vulnerability on this chart was a couple of weeks back as the market broke to a new low. So we had a sequence of 2 lows breaking for a third low, breaking below support. That was the point of for me, maximum vulnerability. And as I told you last week, vulnerability doesn't necessarily mean that a market has to fall hard, but it means it's vulnerable and it's in the position where the probability increases significantly. So we're past that point with the market rallying back to where we currently are. But I think as we look at it now, the market it has gotten back above the moving averages, but really it's still only a snapback rally. It's only a rally that's taken a few days. I don't think we have enough here at the moment to call this a new up phase. Now, of course, that could develop, but I don't think we have enough at the moment. I think the next couple of weeks is really crucial for how this all plays out. And the question to watch over the next couple of weeks is, what happens with this rally? Is the S&P 500 able to consolidate in a relatively, with perhaps a relatively shallow pullback and create a new platform to then potentially move higher from, or does it start to quickly give back those gains? I think that's going to tell us a lot for what the importance of this low point from a couple of weeks back. Is it a significant low or is it a temporary low? I think if we get a pullback, what that pullback look like, well, that probably tells us quite a bit. And I think what we can also do, we can also put in some Fibonacci retracements just to give us some parameters of what a pullback could look like. And these can be quite helpful in these situations. So if this were the start of something more positive and more lasting, I'd expect that the price action would probably be contained to around the top portion of the Fibonacci region, build a bit of a base, and then you can potentially launch higher from that. For me, that's best case scenario looking chart, and it becomes quite a tradable situation where you know where your risk is, and you've got your base. You can exit beneath the base, and you can buy a breakout. But we've got to wait until we get that, till those structures start to form. I think now is still a time for caution because there's still quite a lot in play. I'll show you what I mean. I'm going to show you the S&P 500 equal weight. So this is an ETF, an equal weight ETF, and when you look at this, and this has been the thing really for the last quite a while, maybe a couple of years, in that when you look at the S&P 500 on an equal weighted basis, it's just not as strong. And just look at how this rally from the lows worked. It's come back, it's got to the 50-day moving average, and it's already struggling, and it's pulling back. It's pulling back more than the S&P 500 capitalization index is pulling back. So I think this is one of those things that we need to keep keep a close eye on. I just don't think there's enough here to say that we have a key turning point. And as I say, we're already getting that reaction off the moving averages. Like the S&P 500, we need to see what the pullback looks like. Is it shallow? Does it quickly start to give back the gains? As I was telling you last week, I closed down some risk a couple of weeks ago, and that's really what I've been doing for the last several months. It's like as the markets have been coming down off these highs, I've been easing out of positions as they hit exit levels, and being slow to put on new risk. And I'm not in a hurry, given the way this is structured. I'm not in a hurry to race back into this market at this point because there are still vulnerabilities. For me, it's a case-by-case situation. Looking at stocks, there are stocks which are above moving averages and breaking out. They're the ones I want to look at. But as a general proposition, much of the market is still, it just does not look technically strong. And we've got to let this price action play itself out, give us some clearer signs. Now, if you're getting some value from this, please hit that like button, leave a short comment. Just, hey, thanks for the video. It just tells YouTube you're watching, and YouTube shows other people, which helps me a lot. So please do that. Now, I want to move on and have a look at the Russell 2000, and this is interesting to look at as well, given what I was talking about with the equal weight. First of all, I'm just going to clean the chart up a little bit. We've been using this support level here around 7,010 for many months now. I'm going to take that off just because the way the market's been reacting the last couple of weeks, it hasn't really been paying attention or observing this support resistance. So for now, let's just take it off to clean up the chart a little bit. What I want to do here, I'm going to put on some Fibonacci's with this, and when you just measure out the recent gain, you can see the Russell's already down at its at the lower end of the Fibonacci region. Whereas if you remember back in the S&P 500, it hasn't even got back to the upper range, upper portion of the Fibonacci's. And this hasn't really been the case all year. It's been that the mega caps are generally strong, but the smaller ones are struggling. And then you go and look at the micro caps, and that's an even worse picture. So for me, I'm looking at this, I'm thinking the Russell, it's still below these declining moving averages, and it's hit the moving averages and has reacted swiftly to the downside, getting the lower end of these Fibonacci's. So it's just not a structurally strong position, and it's this lack of participation, which is for me the biggest worry with how this market stacked up. Looking at this big support level coming in at around 1,640, that's the base of the range. I don't see this breaking in the near term. I think for that to break, I think it would take a bit of pent-up energy, a bit of sideways movement, and then from there, if it were to break, it would then, I think it would go after a period of sideways. I don't think it's set up to break now. It's just set up to just meander at the moment. Maybe you can form a base here, but we just don't have that at the moment. And it's this lack of enthusiasm for the small stocks that does worry me, because we do know that healthy bull markets have broad participation. It's not what we currently have. That can change, but it's not the current setup. And I think all we can do is play the current setup, not play the setup that we'd like to see. And I just want to finish up with a quick look at the bond yield. This is a 10-year bond yield, and it's been continuing to come off. And this is something we've spoken about in recent weeks. I've spoken about the divergence, where when you look at the RSI, well, I'll just quickly put the RSI on so you can see what I'm referring to if you're watching for the first time. We've had divergence in the bonds. The bonds have been making higher yields, but the RSI hasn't been confirming. So we've got that, what we call divergence, and that's often a good sign that a market is losing its momentum, and that's been the case with the bonds. What we've got now is the yield has come back to these moving averages. It's got the 50 to 100-day moving average. This has actually got quite a good track record of causing some sort of a rebound. Doesn't always cause a rebound, but quite often you do get a rebound off the moving averages. So it's going to be interesting to see this week is, can we get some sort of reaction off the moving averages? Maybe that coincides with some sort of a pullback in the equity market. But any which way you look at this, I think there's a lot of uncertainty at the moment. There's a lot of cross currents to consider with what's going on with the lack of breadth, what's going on with the yield. I think the play here is quite simple. I think it's keeping a rein on risk. I think it's playing this conservatively. I just don't think this is currently set up for being a time for putting on those big bets and really starting to get back into the market. I think we've got to wait and just keep watching that price action. It's not exciting watching the price action, not doing much, but sometimes that's a better play than diving in and hoping you're seeing something that maybe isn't quite set up yet. So let's leave it there for this week. Thank you for joining me. Hopefully that's been interesting. I look forward to coming back and talk to you next week. Till then, bye for now.